Audit of Inventories and Cost of Goods Sold. Inventories. The term inventories is used to include goods on hand ready for sale, either the merchandise of a trading concern or the finished goods of a manufacturing, goods in the process of production, and goods to be consumed directly or indirectly in production, such as raw materials, purchased parts, and supplies. So inventories have received much attention in both the accounting and auditing literature as well as in the discussions among professional accountants. Auditors' objectives in auditing inventories and cost of goods sold. The auditor's objectives in the audit of inventories and cost of goods sold are to consider internal control over inventories and cost of goods sold, determine the existence of inventories and the occurrence of transactions affecting cost of goods sold, establish the completeness of inventories, establish that the client has right to the recorded inventories, establish the clerical accuracy of records and supporting schedules for inventories and cost of goods sold. Also, to determine that the valuation of inventories and cost of goods sold is arrived at by appropriate methods. Determine that the presentation and disclosure of inventories and cost of goods sold is adequate, including disclosure and classification of inventories, accounting methods, and any inventories pledged as collateral for loans. In conjunction with auditing of inventory and cost of goods sold, the auditors will also obtain evidences about the related purchase, sales, purchase returns, and sales returns accounts. Internal controls over inventories and cost of goods sold. The following are the general aspects of internal control relating to inventories. First, segregation and rotation of duties. It answers the questions: are the duties relating to the inventories, such as purchasing, billing, and accounting, etc., are properly segregated? Are the duties of various persons relating to inventories rotated periodically? Next, authorization of purchases, receipts, and other related issues. Questions: are the goods are purchased with proper authorities? Is there a proper system of receipt of goods? Are the procedures for issue of inventories from the stores is clearly laid down, or other related issues? Next, maintenance of records and documents. Auditors may see important aspects of transactions related to inventories and cost of goods sold with respect to issues such as whether there is any proper documentation of receipts of merchandise from suppliers, whether there is any proper documentation for issues inventories, whether there is any proper documentation for transfer of inventories from one department to another, the kind of inventory record system followed, whether there is any system for determining the cost of work in progress and finished goods, whether the overhead absorption rates properly determined, whether actual cost is compared with standard or budgeted cost and the variance is properly analyzed and adjusted, whether proper records have been maintained for waste, scrapped, etc., whether proper records have been maintained in respect of inventories belonging to the organization but existing with a third party such as warehouses, consignees, customers, etc., whether proper records are maintained in respect of merchandise exits with the company belong to third parties, whether adequate cut-off procedures are followed. Next, accountability for and the safeguarding of inventories. Auditors may see important aspects of transactions related to inventories and cost of goods sold with this regard, such as whether the goods are stored properly to protect against damage, deterioration in quality, etc., whether the access to the place where the materials are stored is restricted, whether the materials have been insured against fire, theft, etc., whether the insurance cover is adequate and reviewed periodically, whether the insurance premium is paid up to date, whether the insurance cover notes or the policy notes are kept in proper custody, what is the system for stock taking, continuous, annual, or both, whether physical verification sheets are made after checking physically, whether any variation exists with the physical verification and as per inventory records, and if there is any differences, the cause for the variation has been investigated and necessary action has been taken. Next, Substantive procedures. The auditor carries the substantive procedures in relation to inventories on the basis of his evaluation of the effectiveness of internal controls. The various substantive procedures may be as follows: examination of records and documents, review or observation of physical verification, examination of valuation and disclosure, analytical procedures, such as quantitative reconciliation of inventories, example reconciliation of quantities with the beginning inventories and purchases with the quantities sold or produced and ending inventories, and comparison of the value of the inventories of the current year with that of previous year, comparison of the ratio of various items to the total items with the ratios of the previous year, comparison of the gross profit ratio of the current year with that of previous years, comparison of the inventory turnover ratios of the current year with the ratio of previous year, comparison of the per unit value of the current year and that of the previous year, and confirmation from third parties, management representation letter, are the analytical procedures. Audit program for inventories and cost of goods sold. The following are the procedures typically performed by auditors to achieve the objectives. First, consider internal control over inventories and cost of goods sold, or test of control. The first to consider is to obtain an understanding of internal control over inventories and cost of goods sold. The understanding of internal control enables auditors to be familiar with procedures for purchasing, for controlling productions, receiving for cost accounting systems, storing for perpetual inventory systems, issuing goods for other related matters, and assess control risk and design additional tests of controls for inventories and cost of goods sold, and perform additional tests of controls for those controls which auditors plan to consider to support their planned assessed levels of control risk, and then reassess control risk for the financial statements assertions about inventories and cost of goods sold and modify substantive tests based on information about weakness and strength of the control systems. After that, perform substantive tests of inventories and cost of goods sold transaction and balance. Example, substantive test, obtain listing of inventory and reconcile to ledgers. Example, schedules of listing of inventories is reconciled to general ledger, control accounts, and appropriate subsidiary ledgers. And its primary audit objective to be addressed is clerical accuracy. Evaluate the client's planning of physical inventory. Effective and efficient inventory planning requires careful advanced planning. In planning inventory count, clients should consider factors such as the following. So it indicates existence, occurrence, and right valuation. Observe the tracking of physical inventory and make test counts. So it indicates existence, occurrence, and right valuation. Review the year-end cut-off of purchase and sales transactions. So it indicates existence, ownership right, completeness, and clerical accuracy. Obtain a copy of the completed physical inventory and test its accuracy. So it indicates existence, ownership right, completeness, and clerical accuracy. Evaluate the basis and methods of inventory pricing. So for example, verify whether the basis and methods of inventory pricing and costing are in accordance with GAAP. Investigation of inventory valuations may involve questions such as the following. So it indicates valuations. Test the pricing of inventories. Example, test the pricing method applied to raw materials, purchase parts, supplies, work in process inventories, finished goods, and other inventory items. So it indicates valuations. Perform analytical procedures on items such as gross profit rate over the periods, inventory turnover, volume of purchase from period to period, and others. So it indicates existence and ownership right, completeness, valuations. Determine whether any inventories have been pledged and review commitments. It indicates valuation, presentations, and disclosure. Evaluate financial statements, presentations, and disclosure. Evaluate financial statements, presentations, and disclosure. Example, see whether there is adequate disclosure of inventory methods, classification change in allowance for inventory, terms of inventory purchase, commitments, pledge of inventory, etc. So it indicates presentations and disclosure. Sample problem. In conducting your audit of Angel Corporation, a company engaged in import and wholesale business for the fiscal year ended June 30, 2020. You determined that its internal control system was good. Accordingly, you observed the physical inventory at an interim date, May 31, 2020, instead of at June 30, 2020. And you obtained the following information from the company's general ledger. Sales for 11 months ended May 31, 2020 is equal to 1,344,000. Sales for the fiscal year ended June 30, 2020, 1,536,000. Purchases for 11 months ended May 31, 2020 before audit adjustments, 1,080,000. Purchases for the fiscal year ended June 30, 2020, 1,280,000. Inventory July 1, 2019, 140,000. And physical inventory May 31, 2020, 220,000. Your audit disclosed the following additional information. Shipments costing 12,000 were received in May and included in the physical inventory but recorded as June purchases. Deposit 4,000 made with vendor and charged to purchases in April 2020. Product was shipped in July 2020. A shipment in June was damaged due to carelessness of the receiving department. This shipment was later sold in June at its cost of 16,000. Solution. In audit engagements in which interim physical inventories are observed, a frequently used auditing procedure is to test the reasonableness of the year-end inventory by the application of gross profit ratios. So, to compute cost of goods sold of 1,008,000, beginning inventory plus purchases adjusted less ending inventory. And with that, we can compute the gross profit ratio. As you can see, the gross profit is 25%. From the given information, the total cost of goods sold for June 2020, as you can see, is equal to 148,000. And then, the inventory of June 30, 2020 is computed by ending inventory of May 31, 2020 of 220,000 plus purchases for the month of June, 200,000, less goods sold at cost, 16,000, a total of 404,000, then less cost of items sold in June, which is 144,000, equals to 260,000 inventory of June 30, 2020. So, in conclusion, inventory audit is an important audit process which include different audit procedure as per the requirements of the company. The process is tedious and requires a lot of manual effort, but play a pivotal role in determining the accuracy and efficiency of the inventory management system and other aspects of the inventories and thus complete audit process. That's all. Thank you for listening.